My first attempt to record this video over a comprehensive pension example did not work, so I'm going to try again. So what we have here is an example with Diamonds International, and we're going to go through 4 years of entries. And what you'll also notice at the bottom of this file is there's a template, a pension template that you can use for homework problems or quiz problems that relate specifically to pensions. So first of all, what we have here is kind of a significant number of rows, and these rows pertain to the different types of activities that can happen when it comes to pensions. So first we're going to start with our beginning balance. Then, if you recall from the lecture, there were several components of determining pension expense. So some of those were the service cost, the interest cost, the actual return. We have other items that can impact the pension balances, which are contributions and benefits. So we've just listed all those out. Now, as we go along and we do more years of this example, that list is going to grow. But we're going to start off with a basic example and then get more complex over time. The other thing that you will notice is I have 2 sets of columns. One is for journal entries and one is for memo record. So the 3 lines under journal entries, or the 3 columns under journal entries, relate to activity that is actually going to be recorded in the financial statements of the company which is providing the pension plan. So we've got our annual pension expense, that's going to be our P&L expense. We've got cash, and then we've got the pension asset liability. So this is going to be the net pension asset liability that has to be recorded on the financial statements. And then over to the right, we have a memo record column. Now remember that I said that the pension trust is a separate entity. And so this memo record is just going to help us keep track of what the value of the PBO is, which is the liability, what the value of the plan assets are, and then we can use those 2 to determine whether or not at the end of the year we're in a net pension asset or liability position. So the first thing that we want to do is we want to carry over our beginning balances. So what they tell us in this problem here is that our plan assets are $100,000 and our PBO is $100,000. So what that basically means to us is that at the beginning of the year, we are not overfunded, we are not underfunded, we are exactly funded. Now that's somewhat unusual, but that's what is going on for this example. Okay, so now what we can do is start filling out our various rows. So they tell us that our annual service cost is $9,000. So we know, though, that the service cost is going to increase our annual pension expense, and then the offset is going to be an increase to the PBO. So it's really important when we're doing these entries that we make sure that we have enough debits to cover the credits. So when you see this column I over here, which says does the entry net to 0, it's just making sure that if I've put a debit somewhere, there's an offsetting credit somewhere else. They tell us that the settlement rate is 10%. We know that the settlement rate is the interest rate on the PBO, and we're going to take the beginning of the year balance on the PBO times the settlement rate to determine how much interest cost is, and that's $10,000. The offset is to an increase to the PBO. Our actual return on plan assets are also $10,000. We know that actual return on plan assets decreases the annual pension expense, so we're going to see a negative number there, and it's going to increase the plan assets here. The other thing I'll mention, and it's listed here in the problem, is that when we're putting negative numbers in our chart, negative numbers are credits and positive numbers are debits. So the reason for that is that when we get to the end, it's going to help us determine what our journal entry should be. They tell us that funding contributions for the year are $8,000. So funding contributions, that is a cash outlay, so we're going to have a credit to cash, and we're going to have a debit to the plan assets because we're investing our money in additional assets. And then finally, benefits paid to retirees during the year are $7,000. Now, keep in mind that when we're paying out our benefits, it's not the company that's paying out the benefits. It's the plan that's paying up the benefits. So therefore, what we're going to see is a reduction to the plan assets because they're going to have to sell some assets to write a check for the retiree. And then it's also going to be a reduction to the PBO because there's a lower obligation now because we've done a partial payout. Now, once we've kind of done our entire year's worth of entries, we're going to subtotal them. And the first thing that we're going to take a look at is our funded status of our pension. So we can see here that we have a PBO of 112 and plan assets of 111. Therefore, our PBO is underfunded, and we're going to need to record a pension liability of $1,000. So now if we have our final year-end totals here, this is what it's going to look like. And now we can use this information to determine our journal entry. So our journal entry is going to be a debit to pension expense of $9,000, a credit to cash of $8,000, and a credit to the pension liability of $1,000. You will notice that that entry balances and aligns with kind of the numbers that we have in our table above. So at the bottom here are just some reminders about how a couple of the numbers were calculated. And now we're ready to move on to 2013. Now, before we move on to 2013, it's important to take a look at our ending balances. So for our PBO and our plan assets, we're going to want to carry over that 112 and that 111. We're not going to carry over the cash balance because keep in mind that this is the activity of cash, not the actual cash balance. An annual pension expense, we don't need to carry over that $9,000 because we know that pension expense is an expense account, which is a temporary account that gets closed out into retained earnings every year. We will want to take note, though, of our pension liability account, and so our first step as we move on to 2013 is to fill out those beginning balances. So there we go. Now, what this problem this year tells us is that they had amended their pension plan on 1/1/2013, and in doing so, granted employees prior service benefits with a present value of $80,000. The annual amortization for 2013, using the years of service approach, is $27,200. So the first thing that we need to do is we need to incorporate in that $80,000. So we know that $80,000 of extra benefits is going to increase our PBO. The other thing is, though, is that we need our entry to balance. And so we know that we're not going to have that offset be completely to pension expense in the current year. We talked about that during the lecture. Instead, what we're going to do is that prior service cost is going to go into OCI, and then it's going to amortize over time using either a straight line method or the years of service approach. So now that we've added in our prior service cost, we are going to subtotal what our new balance is as of 1/1/2013, and we can proceed with the rest of the problem. They tell us that our service cost is $9,500, so that goes into annual pension expense with an offset to the PBO. They tell us that our settlement rate is 10%, so we're going to record 10% times, and this is important, you're using the beginning of the year balance of the PBO. So we're going to use the 192, not the 112. So 192 times 10% is 19,200. That offset also goes to the PBO. We're going to come down now. We have our actual return. Our actual return was 11,100. That decreases pension expense, increases plan assets. Then we have our amortization of our prior service cost. So that is going to increase our expense, our pension expense, and it's going to decrease that OCI balance. We also know that our accumulated OCI before we got to this year was 0, so we had a 0 balance before. Our contributions for the year were $20,000, so that's a decrease to cash and an increase to our plan assets. and benefits paid during the year were $8,000. So a decrease to the PBO and a decrease to plan assets. Again, we're going to subtotal our year, and first and foremost, we're going to compare our PBO balance to our plan assets. So when you compare these two, we are in a net liability position of $78,600. Now, that is not what our adjusting entry is going to be. That represents what our ending balance needs to be in our pension liability. We already have a balance of $1,000, so therefore our adjusting entry needs to be $77,600. We then bring forward our final totals here. Again, this is going to help us determine our journal entry. So we're going to have a debit to pension expense of $44,800. We are going to have a credit to cash of $20,000. We are going to have a credit to the pension liability of $77,600. And we are going to have a debit to OCI prior service cost of $52,800. And the reason that it's $52,800 is originally it would have been a debit of $80,000, but then we amortized a portion of that, $27,200. So a debit of $80,000, a credit of $27,200 gives you a net debit of $52,800. So if we fill that out, okay, what we want to check for then is to make sure that our entry balances. So we have debits of $97,600, we have credits of $97,600, so we are good. Okay, now again we're going to move on to the next year, and in doing so we are going to carry forward our appropriate year-end balances. So if we move on to 2014 now, bring forward our balances here. So what we're bringing forward is our PBO and our plan assets, and our net liability for our pension, and then the OCI balance. Okay, so we have the following facts for 2014. Okay, no additional amendments that would increase or decrease prior service costs, so nothing is going to go there. So our balances are going to carry forward appropriately. Our service cost is $13,000. Debit to pension expense, credit to the PBO. Our interest cost is 10%, so 10% of the $212,700 is an increase to pension expense and an increase to the PBO. Okay, our actual return on plan assets was $12,000, so decrease the pension expense and increase the pension assets. Okay, now we have a new line here, unexpected gain or loss. So if you recall in my lecture slides, I indicated that the FASB allows you to smooth your return on plan assets in order to reduce the volatility that you may experience during, years where there's good market conditions and then years when there's bad market conditions. And so what you're basically going to do is you're going to look at what the expected rate of return is. So the expected rate of return was 10%. So 10% of the beginning balance of the plan assets is $13,410. So what that means is that between the actual return and the unexpected gain loss, the sum of these two rows needs to be $13,410. So if we already have $12,000 as a reduction from the actual return, that means that the unexpected gain or loss needs to be $1,300. Oops, I didn't mean to do that. Let me undo that for a second. $1,410. So the sum of these two is $13,410. Okay, now we know that our actual return was only $12,000, so that means that in this situation we have an unexpected loss, and so the offset to that unexpected loss is going to go into OCI gain loss. And remember that it's going to sit here. It's going to be netted against other gains and losses relating from changes in the liability, and then we're going to have to do that corridor test over time. Now, if we move on, we have the amortization of the prior service cost. That's going to increase our expense, and the decrease is to the OCI prior service cost account. We had contributions of $24,000, so that's a decrease to cash and an increase to the plan assets. And then we had benefits paid of $10,500, so a decrease to the plan assets with a corresponding decrease to the PBO. And then they tell us that we had changes in actuarial assumptions resulting in an end-of-year PBO of $265,000. So what that means is that our PBO at the end of the year needs to be $265,000. The total before that adjustment is $470. So what that means is that we need a $13,530 adjustment. No, that was not the right number at all. Just a second. Perhaps I can't do math in my head. So $236,470. So $236,470, and $265 is what we wanted it to be. So the difference between those is $28,530. So that is what our adjustment needs to be, and that adjustment then also gets recorded into OCI gain loss. So this is going to be a debit there. And then, like I said, at the beginning of every year, we're going to do a corridor test to see whether or not anything needs to be amortized out of that account. So now we're ready for our subtotals. And first thing again we're going to do is compare our PBO to our plan assets. So $105,400 is our net liability. We already have a balance of $78,600. So again, we want our year-end total to be $105,400. In order to get to that amount, we need an adjusting entry of $26,800. I'm going to bring in all of our other totals then, and this again is going to help us determine our adjusting journal entry. So we're going to have a debit to pension expense of $41,660. We are going to have a credit to cash of $24,000. We are going to have a credit to the pension liability of $26,800. We are going to have a credit to OCI PSC of $20,800. That was the activity for the month or for the year. And we are going to have a debit to OCI gain loss of $29,940. So if we do all of those pieces, we should end up with a balanced journal entry, and we do. Now, the other thing that we want to do is get ready to test for whether or not we need to do any amortization of our OCI gain loss in the next year. So our total balance in OCI is $28,940. And in terms of our corridor test, we need to look at what is greater, the absolute value of the PBO or the absolute value of the plan assets. It happens to be the PBO. So 10% of the PBO is $26,500. So we can tell that the value of our OCI gain loss account is greater than that 10% threshold, and that means that in 2015 we will need to do some amortization. So we move on to 2015. We're going to bring forward our beginning balances. We had no additional prior service costs. So we're going to bring forward our 1/1/15 balances. Record our service cost. Record our interest cost. Okay, our actual return was $22,000 this year, so we're going to put in the 22. Okay, they tell us that our expected rate of return is 10%. So 10% of 159,600 is 15,960. We know that, but the sum of the actual return and the unexpected gain or loss need to sum to that amount. So what we're going to do is we're going to take our $22,000 minus our 15,960, and that's $6,040, and that needs to be a debit to pension expense, and because it needs to be a debit because our actual return was greater than our expected return, so we ended up with a gain. But we don't want to show that $22,000 as a reduction to pension expense. We only wanted to show the $15,960. The offset to that is going to go into OCI. Our amortization of our prior service cost was $17,600, so a debit to pension expense and a credit to OCI PSC. Contributions were $27,000, decrease in cash and an increase in plan assets. Benefits, $18,000, decrease plan assets, decrease PBO. We didn't have any additional changes in assumptions, so that's going to stay 0. And then we have the amortization of the gain loss. So I had mentioned in the previous year, at the end of the year, we did a calculation. So we said that our PBO was $26,500. That was the beginning of the year balance. Our actual amount sitting in our OCI gain loss account is $29,940. So the differential between those two numbers is $3,440. We are going to divide that then by the average service life for all employees, which is 20 years. So divide that by 20, and we end up with $172 that needs to be amortized. So that's going to increase our pension expense, and that is going to decrease our OCI gain loss. So then in the next year, right, you would take your new amount of money and you would divide it by the remaining average service lives, so that would probably be 19 years, and then you would recalculate how much you needed to amortize every year. So we're going to come up here with a subtotal. Okay, now the differential between my PBO and my plan assets are $98,900. Okay, I previously had a liability of $105,400, so now I'm actually going to be adjusting my liability downwards with a debit by $6,500 to get my new year-end total to be that $98,900. Going to bring across the rest of my numbers. So what I'm going to have here is a debit to pension expense of $44,312, a credit to cash of $27,000, a debit to pension liability of $65,000 because I'm reducing my liability. I am going to have a credit to OCI prior service cost of $17,600, which is the activity for the year, and I'm going to have a credit to OCI gain loss for $6,212. So if I record my journal entry, again, when you get to your entry, you should have your debits and your credits equaling each other. They do, so I know that I have the right answer. I just also want to point out the reason that I debited pension liability and not debited pension asset is because I'm still in a liability position. I just have a lower liability than I did in the previous year. So hopefully this example was helpful and kind of walked through the steps and built up the complexity of the problem. As I mentioned, this is posted in the week 6 content, so if you want to run through it again on your own, or if you want to utilize the pension template, you certainly can.